A rich life isn't a straight line to a destination on the horizon. Sometimes it takes an unexpected turn. With detours, new possibilities, and even another passenger, or three. And with 100 years of navigating ups and downs, you can count on Edward Jones to help guide you through it all. Because life is a winding path, made rich by the people you walk it with. Let's find your rich together. Edward Jones, member SIPC.
Not every sale happens at the register. Before AT&T Business Wireless, checking out customers on our mobile POS systems took too long. Basically a staring contest where everyone loses. It's crazy what people will say during an awkward silence. Now transactions are done before the silence takes hold. That means I can focus on the task at hand and make an extra sale or two. Sometimes I do miss the bonding time. Sometimes.
AT&T Business Wireless. Connecting changes everything.
I'm Scott Wapner, and you're listening to CNBC's Halftime Report, the podcast, the most profitable hour of the trading day. We record this live weekdays at 12 Eastern. Listen in.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The state of the markets is more presidential threats, FOMO fears, and overall uncertainty continue to keep investors guessing. We will discuss and debate the markets with the investment committee. Joining me for the hour, Joe Terranova, Jim Leventhal, Stephen Weiss, and Bryn Talkington. We'll show you the markets here. We're just past 12 noon, obviously in the east, and we're hanging in there. We are green across the board. Oil stable. Yields are stable. Feels like we're in a bit of wait and see, Joe, for the alleged 8 p.m. Tuesday Trump deadline. So we'll see about that. And it's worth, since it's a new week, and we usually do this, is give you kind of the scorecard.
Sure.
For where we are since the war started. The S&P's down 4%. Feels a lot worse than that.
A lot worse.
There's no question about that. And under the surface, it probably looks a little worse than that because the mega caps have traded better lately. So that's helped the S&P. Mike Wilson, Morgan Stanley. We remain in a bull market. The main risk remains central bank policy and rates. Doesn't say the war. UBS, we think investors should remain positioned for medium-term upside in global equities. And Ed Yardeni says we think there's good value in the stock market at current levels. All right. What say you?
So I agree with Mike's comment regarding a policy mistake on the part of the Federal Reserve being a really big headwind that you would introduce to the marketplace. I think they should not be reacting to the spike in oil prices with not only the implementation of a rate hike, but even the talk of it. I disagree with that. I think internally within the market, we are pushing towards the 200-day moving average. And if I were just to step back and really not know about this binary 24 or 36-hour period that's in front of us right now, I would suggest that the market can move higher from here. And the reason for that, I think, is we have worked off a significant amount of bullish positioning and bullish sentiment. And I think that works in the favor of markets lifting here. I think in the interim, what you want to do is you want to look at the exchanges, which continue to perform remarkably well, whether that's CBOE, CME, ICE, NASDAQ, all of them working really well. And look, I pointed it out last week, and full disclosure, I don't own the stock. I would never do that because I have a very long-standing friendship with the owner of Virtu Financial. But you have to point out that company as the only true publicly traded market maker that you could buy shares of, and it is trading it to an all-time high today. It speaks towards the volatility that's in the marketplace right now and trying to allocate in that direction.
Okay. We appreciate the disclosure on that. In terms of, we've had a fair amount, Weiss, of de-risking in the market, right? Some say, well, we didn't go down enough. We didn't have the classic capitulation, blah, blah, blah. But if I told you that, according to Goldman Sachs, on a trailing 6-week basis, net selling by hedge funds was the third largest over the past decade, and that CTAs had sold nearly $55 billion in U.S. equities since the start of the war, you'd probably say that sounds like a pretty good amount of de-risking as this whole thing began, and maybe that has run its course as to why Joe thinks you could still have some upside and to why Mike Wilson's willing to say we're still in this bull market until we're not, and UBS talks about medium-term upside as well.
Yeah, and the reason to point them out, they're the marginal buyer and the marginal seller. Index funds, which are more than half the market, they don't have cash positions, right? That's not the point of being an index fund. It's to match whatever the stocks are in the S&P. So there's no cash there. Most long-only managers, maybe they can own 10%, maybe they can have 10% cash, maybe they don't, but typically they don't get paid to be the asset allocator. So they're typically all in, except keep some cash opportunistically. So that brings you back to your example, CTAs and hedge funds, which don't have the biggest asset base, but they're big enough to influence direction of the market. And right now, their exposure is pretty low. Their gross is pretty high, so you get to a high gross by having low net exposure because you've got short positions. CTAs, they may be net short because of the
No, they are, according to this. They're about $18.5 billion short.
Right. So that is potential buying firepower that has to come in. So the only question to me is, and this is a question nobody can answer, what happens? Do you go after Iran's energy infrastructure? If you do, then you'll put a floor under oil at a much higher level, and that could really turn over the apple cart. Overall, I agree, intermediate, it looks fine. Long-term looks fine. It's no secret you can have 14%, 14.4% earnings growth this quarter. So that is attractive for stocks. The guidance, I don't know about the guidance. Is it going to be somewhat couched and we don't know what happens?
Probably.
Yeah, it should be.
Probably.
But overall, productivity because of AI is increasing dramatically.
We always, not always, but, you try and criticize, they're going to, never waste a crisis, so to speak, to think about how you guide. But I think post-Liberation Day period and also now, given the war uncertainty, it's fully justified for CEOs on these earnings calls to say, we feel pretty good about the environment, but we just don't know if this lingers on any further. That's going to leave people maybe dissatisfied, Jimmy, with what CEOs see. But until the numbers change, like the Weiss talking about 14.5% nearly earnings growth, then the commentary doesn't really matter much.
Yeah, so talking about earnings growth, and now we're up to 16% projected year-over-year growth. The amazing thing to me is that earnings estimates for this year on the S&P 500 have increased by 3% since hostilities broke out. And some may want to say, okay, well, that's higher energy prices flowing through to energy companies. It's not. That's a part of it, but 3 times that effect is going to be felt in technology stocks. And by the way, it's going to be a good 3 weeks or so before we get technology stocks reporting. So I think the real danger to this market, if there is one, is that technology stocks disappoint either in reported results or, Scott, as you're just pointing out here, in the guidance. But we've got 3 weeks.
What are the chances of that, honestly, Jimmy?
Well, here's I don't think it's a high chance.
Let's just not state it as throwing it out there in the wind. What are the real probabilities that these big tech companies are going to disappoint on their numbers or their spending plans and all that?
There's 2 things to consider. One, expectations are high. They've done nothing but rise over the last 3 years. The second thing is there are going to be margin pressures, particularly from the semiconductor space. We do know that there are pressures on the supply chain in semiconductors. We all know very well what's going on with memory chips and pricing there. So I don't think, let's be clear, I don't think these stocks are going to disappoint, but I don't think we can rule out that along the way there are some disappointments. Remember, by the way, last quarter, Microsoft, for instance, disappointed because they were supply constrained in building out Azure growth. So things like that can happen. But ultimately, just go back to this week, it's hard to, and famous last words here, it's hard to see things getting worse. Like, do we think that the Strait of Hormuz is going to be more closed? There's about 10 ships going a day through the Strait of Hormuz. Before the hostilities, it was over 100. So, of course, Iran can bomb more energy fields, refineries, et cetera. But I do think that, it's hard to see things getting materially worse.
It's hard to try and use technical analysis, I think, at moments like this, because in certain instances, this is different in that if you say, like Jonathan Krinsky does today, that the bottom's not in yet, the reality is we're lacking the fully oversold conditions that typically accompany a breach of the 200-day moving average, especially since that breach has now lasted 11 straight days. I'd say, well, of course, that can be true. We didn't have, according to those who watch Bryn, the classic capitulation or full washout, but you also don't have the classic kind of communicator, I suppose you could say, in the Oval Office. I mean, people are afraid of being too negative. If maybe you didn't get and wouldn't get the classic washout that you would expect at times like this, because people are afraid of missing out on a post on social media, a change of direction. It's happened sometimes multiple times a day. The language has. So it's left people, I think, a little confused as to how to position, but certainly afraid to be too negative this market.
100% agree. I think the way I'm looking at the technicals from the 200-day, we don't have to have a washout. Those washouts are actually quite rare. We had it at Liberation Day. We had it during COVID. And so what I look at, and I think what's been a very good guide, is we broke the 200-day, I want to say March 18th or 19th. Going back 20 plus years, if we get back above the 200-day within 30 days by April 19th, there's actually a 100% hit where the market's up a year later. If we do not get above there by April 19th, the data is not so great because then it starts turning down. And so I just think that we still have a couple of weeks. I don't think we need a washout, but I do think investors watching the 200-day, let's see what happens. And I will say, Ed Yardeni had very good points in his piece about the fundamentals that, yes, Jim's talked about earnings are going higher, that if you go back really since the World War II, 2 years later after major, we'll say military excursions or military wars, et cetera, 2 years later, the market's up on average between like 35 and 44%. So it's like worth it to take the risk. And then earnings are going higher. And so I think between fundamentals and technicals, we're still so close to the 200-day. We're like 30 points that if you are getting very short, I think to your point, that is not a good idea because there's no clear indication. But I want to close and say one thing about tech earnings. To me, the one thing that does give me pause is tech is looking to grow 30% this year, let's say overall earnings growth. All of that is NVIDIA and Micron. If you take NVIDIA and Micron out of Q1 S&P earnings, the S&P earnings is like 3%. And so I will say we are hyper concentrated with two names. And so one thing I don't like is the breadth of earnings within tech. Google, Apple, Microsoft, and Meta, their earnings growth this Q1 is not great, by the way. It's all Micron and NVIDIA.
Joe, the fact of the matter is in this current market, the risks are so easy to see both ways. In a highly foggy and opaque environment, I could easily make as negative a case as I could a positive case.
Yes.
Ceasefire, you get all negative, you get a ceasefire, market's going to rip. In part because the shorts, there's still a lot of shorts of the institutional side. You get a short covering rally like that. You get all bulled up and then you get some degree of escalation. Okay, well, obviously, I can make a cogent case that the market's going to be susceptible to significant downside on that. So then just X both of those out, play the hands you got. The hands you got is that earnings are expected to be good. The macro environment is still pretty good. I know there are risks, and Jamie Dimon mentions them in his shareholder letter yet again today. Some are worried about the Fed making a policy mistake. But again, cut out all that noise and just play the hand you got right now. Markets, the economy's pretty decent. The jobs report, surprise to the upside. You can hit it on some of it was volatile and, the revisions, et cetera. But that's what I think we're looking at.
But I think you're correct, and I think what that means to the viewers and certainly the wealth management industry, Jimmy, is that this isn't an inflection point. This isn't something that is similar to what we were experiencing in the early 2000s or around the great financial crisis. This is something where we have elevated volatility, a recalibration on valuation, and therefore we have corrective price action.
Let me hold you just for 2 seconds. We're going to go to the White House. Megan Cassella is there. The president is making some comments. Obviously, the Easter egg roll this morning, and let's listen in to what Megan's reporting is. Hi there.
Scott, that's right. This is the second time now we heard from the president out on the South Lawn this morning ahead of his 1 p.m. press conference. And what he was doing here is he was knocking down the idea primarily of that 45-day ceasefire proposal that we've been talking about so far today that's being pushed by intermediaries. This is the idea that a 45-day ceasefire would take effect ahead of the president's tomorrow 8 p.m. deadline to reopen the Strait of Hormuz while a broader deal was being negotiated. What the president said just now was, quote, the only one that's going to set a ceasefire is me, referring to himself, knocking down that idea of the proposal. He had earlier called it not good enough, but a very significant step. So more to come possibly in the later press conference about how he feels and how he does want to proceed. He also was really maintaining a firm deadline on that tomorrow 8 p.m. deadline that he set. Of course, he has moved this around a few times. That's the deadline for the Iranians to reopen the Strait of Hormuz, or he says he'll be targeting things like power plants and bridges. He says that, yes, that is the final deadline this time around, and he also appeared to brush off any concerns that targeting those power plants and bridges, given that they are civilian infrastructure, would amount to a war crime. He said he wasn't worried about it, and he said instead that the only war crime is allowing Iran to have a nuclear weapon. He also gave us a little bit of color on how negotiations are ongoing, or at least who is leading them. He said that the Vice President, J.D. Vance, is involved in those negotiations with the Iranians or with the intermediating countries. He also said that Steve Witkoff, the special envoy, and Jared Kushner are involved in those negotiations as well. And when he was asked whether the Vice President might be dispatched to have some in-person meetings with the Iranian counterparts, he said he could be. So more to come on that front as well, Scott.
All right, Megan, thank you. Megan Cassella, head of the president's news conference, about 45 minutes or so from now. So, again, we discuss, play the hand that you have. Mm-hmm. Let's talk about that in the context of Weiss positioning, okay? Because we've talked a lot about, it's been hard to hide, okay? The Russell 1000 Value Index up 2.4% so far this year, beating the Russell 1000 Growth Index, which is down 9.1. It's the largest margin since 2022. The gains, though, for many value stocks are now at risk. Some are suggesting, with the escalating conflict roiling the stock market, oil prices are obviously up. It's hard to believe in the broadening trade against that backdrop. That's what they're saying. The belief in that in the early part of this year had helped value outpace growth. Technology had sold off. Mm-hmm. Everybody knows that now. But now money's starting to flow back into tech, which has made the environment a little more difficult to figure out from a positioning standpoint.
So if you go back over the 15 years, we've had these false starts where value was going to be the lead horse and take over for growth. And I still think that's going to be the case, where value is going to be there for a little bit, then it's back to growth. It's back to fortress balance sheets. I agree that their free cash flow has been impinged somewhat by their spend, but given where we are in the demographics of investing, that you're more likely to find growth leading at any particular time. And so when there are values to be had there, as there were when the NASDAQ was in correction territory, people are going to seize it. So, look, I don't really know what value is anymore. When I take a look at Caterpillar, which I own, which used to be a value stock, and now it's still overvalued. So I think the waters have gotten murky. Clearly, the only one that's drawing the lines towards value versus growth are the ETFs that are value ETFs, because it's got a title to it.
Let's just say almost everything but tech. So right? I guess for the context of
that's
this,
Banks.
For this conversation,
the outperformance of energy and materials has contributed to value surging and having this mean reversion advantage over growth. If you were to tell me as we move forward to Jimmy's point that things don't get any worse and oil prices retreat, then I'm with you, Steve, because then I think it's about the Mag 7. I think it's a rebuilding of position and technology. And I think overall, you want to be tactical. I still believe in this environment. You want to be tactical. I bought Apple at 252.5 last week. It's now approaching 260. On the close today, if it is sitting here close to 260, I'll add to the position. I'll try and build a position as it moves higher. I think you want to see these tactical opportunities as they are presented to you in front of you. It's refiners, it's fertilizer names, it's the exchanges. Those are the areas right now where you can find a little alpha.
Bryn, tech saw the biggest inflow in 4 weeks last week. The gains for a lot of these mega caps over a 1 week period have been pretty darn good. Alphabet up 9% in a week. Now, a lot of these names I'm going to read to you certainly needed this, because the week prior, it would have looked like the opposite. Meta up 7.5% in a week, NVIDIA 7%, Amazon, Apple, and Microsoft all with pretty good gains. And as we said, tech had the biggest inflow in 4 weeks. So in times of uncertainty, especially about the macro, perhaps, money's going to flow right back. And we're learning that lesson over and over again.
Yeah, and then also to that, the premium of these tech companies to the S&P has come down dramatically. And so I think it's hard to get too bearish on tech in general because, as we said at the beginning of the show, albeit it's concentrated, all of the earnings growth is coming from, or the majority is coming from technology. And ultimately, these companies are investing in a new technology called AI. There'll be a ton of waste. We see a ton of waste at Meta that they've already wasted. But ultimately, I think it's just too consequential if you're going to get bearish because these names are just such a big part of the index. And also going into earnings, I think Google's going to have great earnings. I think Apple's going to have great earnings. So why would you want to be bearish on these names after they've already had a correction when in about 2 weeks they're going to come out with earnings, which I think will be very strong just in aggregate?
Yeah. What do you think, Joe? I mean, NVIDIA's gotten 170 back the other day, right? We had waited. It was stuck. It got above and it's held. So, now it's nicely above. But there's the dip last week and then the recovery.
Look, I've spoken over the last several weeks about how I don't understand the frustration that appears to be exhibited in the industry regarding the performance of NVIDIA over the last 6 months. Okay, it's down 4%. I understand that, but it's basically consolidating. And I think your expectation is that this consolidation base leads to, over the next 6 months, an overall advance. I don't think anything about the semiconductor industry is telling you a story that we're going to see a deterioration in the quality of earnings. I think when you look at the semi-equipment names, I think when you look at some of the semi names like AMD, there's a really embedded, powerful story underneath that's suggesting AI is advancing much faster than we anticipated. Agentic AI is advancing much faster than anticipated, and therefore the need, the pull, the demand for these chips is going to remain insatiable.
Well, sure, but if you look at, Jimmy, we can just look at Micron for a moment. I know you don't own it, but it needs to be looked at almost every day. So it's 380. Let's back it out for, I don't know, a month. Let's take a look at a month because it tells the story here. There's your big slide down. So it was $314 on March 31st. It's had a nice move, obviously, since that. So we're at 381. This is almost now a barometer for how the semis are being perceived within the market.
Or at least a segment of it, which is the memory chips. And as I mentioned before, there's high demand for the memory chips. Prices have been going higher. And unlike normal cycles for memory chips, there hasn't been a flood of new supply coming online. So that slide over the last few weeks is not because of new supply. It's because of companies that use these chips finding other solutions, finding more ways to be efficient, and perhaps decreasing the demand. Ultimately, I think the demand is going to be there for these memory chips. As I referenced earlier with Microsoft, that wasn't the only one. I mean, there are a lot of companies out there that have been looking for, and this isn't even to, I'm talking about AI applications right now. This is to say nothing about non-AI applications for memory chips where they just simply can't get the chips.
You had a nice buy in this.
Yeah, in Micron, I didn't get anywhere near the bottom, but I thought it was overdone. I didn't try to get the bottom. I wanted to get it when it was on the upswing and bouncing back. Because if we go out to next year's earnings, and who knows what they'll look like, but right now, the guidance or the prediction for next year's earnings from analysts is that it's a very cheap stock. It's back to where the commodity should be priced. But to Joe's point at AMD, if you look at the chart on NVIDIA, to your point, or AMD or Taiwan Semi, they're all in consolidation phases. Now, they didn't have the big drawdown that NVIDIA had, but that's where a lot of tourist money is. So I think the whole space is really consolidating at this point.
Bryn, the only other stock I want to hit before we take a break right now is Tesla. You own it, as we know. JP Morgan made a call on it today that's underweight, okay? 145 is the price target. They're looking at 60%-ish downside from here. I'm wondering what you think about this. So the deliveries have been bad. There's no other way to say it. They're tracking 7% lower than the most recent consensus and 74% below the prior consensus. Stock down 20% this year, 28% from its 52-week high. What do you say about that now?
I thought that was like Steve's report, not JP Morgan's. It's like, so if
Steve
the market is going, if the market is going to price Tesla on the Model 3 and Y deliveries, right? Because the S and X are going to go away. Then I think his math or her math could be correct. But we know the market does not price Tesla on that. And I think one of the things that we will want to see is that the S and X were discontinued in Fremont, and they are converting that gigafactory to Optimus production. And so we'll see how that's coming along over the next few quarters. But I think to get a one handle on this stock just has to be a complete re-rating of how the rest of the market values it. So I disagree. I will say the stock's in a really strong downtrend. I'm continue to sell calls and sell those down because it is in a downtrend. I think probably it could get into like the 315s, 320s before it stops falling. But you're going to need to see some news on Optimus this quarter's earnings and where they are to get the stock out of its current free fall.
All right, we'll take a break. We'll come back. We'll talk about our calls of the day. One firm seeing more than 30% upside for one of the cruise operators. We'll tell you which one next.
Retirement isn't just about closing out your career. It's living the life you've always dreamed of. With New York Life, you get the financial guidance to make it real. Start today at NYL.com.
You probably know Vistaprint for business cards, but did you know we print everything you need to brand your business? We print banners and signs that help you stand out, and must-have merch like tote bags, t-shirts, and hoodies. Right now, new customers can get 20% off with code NEW20, because if you need it, we print it at Vistaprint.com.
With Share My Trip from Uber, you can send your live trip location to the ones who matter most. Like Dan and Hannah, who always wait up to make sure their daughter gets back to her college dorm room. Or Tiffany, who's running late as usual, and her friends are tracking her trip to make sure she's actually on her way.
Look, she's right there. She's 3 minutes away.
Or Sam, who never goes anywhere without her roommate knowing exactly where she is. Some journeys are meant to be shared. Share your ride in real time with Share My Trip on Uber. One more way Uber is putting safety at every turn. Learn more on the Uber app.
All right, welcome back. Barclays today likes Royal Caribbean. They reiterate their overweight rating, 361 is their price target. They say the escalation in tensions in the Middle East negatively impacted March cruise prices in Europe. I don't think that's any surprise. No. While giving somewhat, though, of a boost to the Caribbean. And that is the trade-off as to why they're bullish. You own the name.
Yeah, but they left out fuel costs, which I think are the biggest concern here as you move forward for this company. Understand when everyone likes to talk about Brent and WTI, it's really diesel pricing that has been most dramatically affected. It's the refiners that you want to own in that scenario. But
right,
Caribbean,
I'm going to gather they're not
costs.
making such a tactical call. Like, that's the challenge of what we're talking about here.
Yeah.
If you want to say that rising fuel prices are a negative for the airlines and the cruise ships and everything else, it's like, no, you know what? But we're trying to look past that. Investors are to make longer term decisions and use some of the dislocation that's happened in some of these names. Mm-hmm.
Okay,
to
so
actionably do that.
You know what
I mean?
While we speak about this, let's pull the chart back 1 year on Royal Caribbean. And what you'll see is that the peak occurred in August. Now, look, I am surprised. We've been in this name, and this is where the strategy is smarter than I am. We've been in this name since April of 24 at $139. I would have never expected to be in Royal Caribbean for the better part of 2 years. But you'll see that the stock peaked last August. Then once again, once the conflict began, you saw the precipitous decline. So I guess what I would say to you is that you have to tell me, to your point, this binary outcome has to work in the favor of resolving where diesel and fuel prices are ultimately going to go for the reset to start on Royal Caribbean and for them to be correct. I don't know the answer to that.
Saying, do you think that fuel prices are going to be lower 6 to 10 to 12 months from today? Will they be?
From the moment where we are today? Yes. Yes, I do. Do I think they could be?
These calls are often based, unless they're specifically tactical in nature.
You didn't ask me this question, but I think this is important. Do I think over the next 6 months they're going to be elevated to where they were over the last 6 to 9 months?
Well, I'm not saying they're going to be back to 60.
Right.
But in 6 months from now, if you think that oil prices are going to be at $110, then the market's not going to look like it does now.
Then Royal Caribbean is basically going to be sitting between 250 and 300, bouncing back and forth. But I don't think, and we own the name, and I like the fundamentals. They are a clear leader in the cruise industry. But over the next 6 months, I don't think they're going to have the margin benefit that they had in the last 6 to 12 months from lower fuel prices to that degree.
Okay, so Jefferies today cuts the targets across many of the gaming names. And they talk about most markets facing headwinds now throughout the year. Vegas tourism's choppy. Macau's now has tough comps and the like. Las Vegas Sands, Jimmy, downgraded today to hold from buy, target to 61. Wynn target goes to 150 from 162. They still say buy it, but. What do you think?
Yeah, I mean, that would be a 50% rise to the revised target. I mean, the thing about Wynn is they have this Al Marjan project, and it's literally on the Strait of Hormuz. So, of course, the stock has sold off over the last month, but that resort is not opening until next year. So, presumably, we're going to get the end of hostilities.
You don't think that's pushed back at all now?
Maybe a little bit, but
and you're banking the whole thing on this to that? You're banking the bull case to that?
This is key. All right. Now, look, you can have a resurgence in Las Vegas, which has been really dormant for several quarters now. Everybody knows that. But the special sauce about Wynn Resorts is this Al Marjan. Could they push it back? Of course.
No, but I'm saying
like a month.
You're telling me that people are going to just, happily rush to the Strait of Hormuz to gamble?
No, there's the question.
Honey, let's go play some blackjack at the Strait.
Okay. There is the question. I mean, if we're talking a year from now, I got news for you. If this thing ends this month and we're talking a year from now when this thing opens, yeah, memories are going to be pretty short in that regard. I mean, all of the Gulf countries have placed a lot of faith on continuing to build out tourism. If that doesn't happen, their economies are in shambles, frankly. Oil doesn't save them from that.
All right. How about Netflix getting a ton of love lately and another one today, Weiss? Upgraded to a buy from neutral at Goldman.
Yeah, Goldman's
target goes to 120. I mean, everybody's now on the same side of the boat. It's like, okay, this thing got hit. They're not doing the deal, so buy the stock. Really, I know that's oversimplifying it, but that's pretty much what these feel like.
And there's still sellers out there. I mean, when Goldman's been a long-term bear or neutral on the stock, and it started to tick up a little bit pre-market, but now it's last I looked, and there it is in negative territory. So I think you still got to do some washing out here. I don't know who it is, frankly, that's a seller because stock's cheap. They still are the best game in town. Still the most content, and they're raising prices, and they're going to sports, and they're going to games. So I think it's perfectly set up. Just got to get it above par.
All right, let's go to Christina Partsinevelos now for the CNBC News Update. Hi there.
Hi, Scott. Well, the Associated Press right now plans on cutting roughly 5% of U.S. staff as part of a restructuring effort. The news outlet looks to move away from hyper-local print coverage towards more video and national coverage. A note from AP's executive editor says just too much of the outlet's operations are tied to large U.S. newspaper groups who make up less than 10% of its business. The U.S. Marshal Service allowed some members of Elon Musk's security team to sidestep experience and training requirements, according to emails acquired by NBC News. The U.S. Marshals approved a request from the White House to deputize Musk's bodyguards, allowing them to carry weapons in some federal buildings during Musk's 5-month stint as head of DOJ. And the Artemis 2 mission reached the moon early this morning and is expected to set the record for humans flying farthest from the Earth. It should happen just before 2 p.m. Eastern time today. The crew will go around the far side of the moon, ending up 252,760 miles from our planet around 7 p.m. before they begin their trip back home. Scott?
All right.
Back over to you.
Christina, thank you. Christina Partsinevelos. Straight ahead, your ETF edge. Dom Chu's got that today. What do you got today?
All right,
Dom?
so Scott, we're going to take a look at which parts of the ETF market are seeing some of the most interest given the ongoing war in the Middle East. And it's not just oil and gas companies getting all the attention. That story is up after the break.
Retirement isn't just about closing out your career. It's mornings that begin with a sunrise instead of an alarm, and the freedom to live the life you've always dreamed of. With a New York Life financial professional, you'll have the guidance to make it real, so your years of hard work become the life you've always imagined. Your life. New York Life. More powerful together. Start today at nyl.com.
A question from AT&T and FirstNet. When you dedicate your life to saving others, don't you deserve something dedicated to you? We think so. That's why the government chose us, AT&T, to build FirstNet, a one-of-a-kind nationwide network for first responders. Because their connection changes everything. Learn more at firstnet.com.
At California Closets, we design for the little things. Take this moment of a family getting ready to leave the house.
Where's my backpack?
Mom, I need my cleats.
My wallet was right here.
If I trip over these shoes one more time.
And now, the California Closets version of that moment. Entryway and home storage solutions by designers who get you. California Closets. More room for what matters.
Welcome back to the Halftime Report. I'm Dominic Chu with today's ETF Edge. Now, market volatility has not really dampened investor demand for ETFs, but it has created a noticeable shift for investor focus back to certain maybe tried and true sector-based strategies. Joining me now with that story is Todd Rosenbluth, Director of Research over at VettaFi. Now, Todd, for a while we saw intense focus on more exotic products, actively managed ones at that. What's driving this renewed interest in returning to more basic sector allocations and industry allocations?
Well, the volatility that we've seen in the marketplace, geopolitically tied to the war in Iran, has caused investor interest into energy ETFs. So the Energy Select Sector SPDR ETF, XLE, was very popular a month ago and remains popular. Energy is a relatively small sector to the S&P 500, 3 or 4%. So we are seeing investors add exposure using that State Street Energy SPDR ETF. We're also seeing investors look at the Alerian MLP ETF, AMLP. MLP's the energy infrastructure space is a more stable cash flow generating space within energy, and you won't find MLPs within the S&P 500. So we are seeing interest in AMLP as well as an alternative.
All right, maybe no surprise here, Todd, that oil and gas, because of the rise in prices, precipitously so, has been a focus. Where else have we seen more of these inflows into certain sectors and industries tied maybe more directly to the war in Iran?
You're right. So aerospace and defense has been an area that has been in focus for understandable reasons. I think the audience can probably appreciate. Investors want to get in, but not just towards those tried and true aerospace and defense ETFs, but we are seeing SHLD. We're showing that on screen. The Global X Defense Technology ETF sees strong interest, and the Rex Drones ETF, DRNZ, which is a relatively new ETF, index-based, that's offering a more technologically advanced way of getting exposure to the aerospace and defense industry. That's also performing quite well.
All right, so specialized parts of oil and gas and more specialized parts of the defense trade as well. Thank you very much, Todd Rosenbluth, for that. We're going to continue this conversation over at etfedge.cnbc.com. Todd's going to be joined alongside Jeffrey Rosenberg, Senior Portfolio Manager for BlackRock's Systematic Fixed Income Group. Big conversation about a lot of market risk factors, Scott. I'll send things back over to you.
All right, Dom, thank you for that. Dom Chu, coming up, the IPO race heating up. New reporting today about OpenAI's plans to go public. Our Kate Rooney, as always, following that money for us. She'll join us next. Welcome back to Race to Go Public, heating up. The information reporting today. OpenAI's leadership said to be split over the timeline for an IPO. While SpaceX will be the first of the big ones this year, certainly looks like that, eyeing an IPO as early as June. Our Kate Rooney is following all of that for us. Hi there.
Hi, Scott. So bankers that I've been talking to are gearing up for hundreds of billions of dollars in new issuance, with deals hitting trillions of dollars. These are levels they have never seen. You mentioned SpaceX, Scott, expected to make the biggest debut as early as June, reported $2 trillion with a T dollar valuation. about $75 billion being floated on the market, according to reports. A source close to OpenAI, meanwhile, tells me that tech giant is preparing to be next in line. OpenAI is on track, from what I'm hearing, to list as soon as Q4, actively meeting with bankers right now, according to a source. I'm also told that CFO Sarah Friar will make the call depending on market conditions. Could be later this year that she actually makes that call. In the meantime, company pushing back aggressively on those reports you mentioned, Scott, by the information this weekend that Sam Altman and Sarah Friar are at odds over some of the mega spending plans and then what that could do to the timeline of an IPO. Joint statement from those two telling us in part we are fully aligned. And then they talk about durable access to compute at the core of their strategy. Call it a key differentiator there. You can see the full quote. A source, though, close to those two, telling me that the executives are, quote, confident about an IPO and that demand after raising $122 billion in private markets. That process showed, according to this person, that investors did not balk at the $600 billion in compute spending that is set to come over the next 5 years for that company. Also told they are focused on retail investor demand, similar to what we're hearing from SpaceX, which might reserve about 30% of the float for individuals. Finally, Anthropic, last but not least, said to be the smallest of those three, sources tell me. Could be as early as Q4, although some of the government back and forth, that lawsuit throwing a little bit of cold water on that timeline. Bankers are highlighting the competition, especially between the AI giants, to list first, reminiscent of what you saw with Uber and Lyft, Scott.
All right, Kate, thank you. It's Kate Rooney, the latest on that IPO race, as we said. So, Bryn, SpaceX, interest you, the IPO? You going to be a buyer?
Well, I think they're trading at 125 price to sales. I think in 2025, they did 16 billion in revenue. The company's been private so long, and I think this is a great case. Amazon IPO'd as a small cap. This will IPO as one of the largest companies in the world. And so I think the juice has been squeezed from this orange. And so I won't be buying it when it IPOs. I just think a lot of the value has already been bid in there because it's once again 16 billion.
Do you in any way think that either any bit of the current weakness in Tesla or future could be pegged to retail sort of using that as a source of funds in any way to gear up for SpaceX or any of these others?
I've heard that a few times. I don't think so. I don't think people are like, oh, I don't want to own Tesla because I want to own SpaceX. I think Tesla has its own issues that we talked about earlier. They need to deliver on Optimus, need to deliver on a bunch of stuff. And so I don't necessarily have any data to back that would be true, but it could be. But I just think right now, OpenAI, SpaceX, all of these companies never went public like they used to go public. And so what is left for investors? I mean, so much is priced in with a company that's doing 16 billion in revenue at whatever, 2 trillion market cap. It just makes no sense to me.
Yeah, when you take a look at, first of all, one of the big reasons they're going public is to be able to give public stock to employees and let employees cash out as well as others that were early. But when you think about it, you got a $2 trillion company. Bryn gave you the numbers. How much return can you generate off a $2 trillion company? It's got to go to $3 trillion, be up 50%. You know, I mean, it's ridiculous to be one of the largest companies in the world on that revenue base. It just doesn't make sense. I think they'll be disappointing public companies.
Wow.
2 quick thoughts on this. I think capital has to come from other places for OpenAI and SpaceX.
Yeah, people talk
within
about
the
maybe
markets.
The mega caps.
Absolutely. And then Anthropic is the one that's exciting to me. And Bryn's Zoom is a great way to get in front of that. In 23, they invested about $50 million, which is probably worth somewhere around $2 to $4 billion right now.
For Zoom's shot right now or the stock? So, talking about like Bryn on Zoom right now, or are you talking about the Zoom stock?
Well, Zoom's shot looks great, but also Bryn owns Zoom Communications
nice
as well.
Good.
And Zoom invested in Anthropic.
Not breaking up at all.
No,
it's the $1 billion shot right there.
Yeah. Well done, everybody. Mike Santoli's next. Senior markets commentator, overtime co-anchor Michael Santoli is here at Post 9. As you look at what's priced in to this market today, it's just a confusing It's a confusing question.
It's confusing because the market is confused. In fact, today is a good example of it, trying to kind of really not say a lot with this minimal movement. Anemic volumes, actually. We obviously had the rest of the world mostly closed for trading today. But I do think that the market is trying to stay on this balanced footing and say to itself, look, we've reset valuations to a point where if under 20 times S&P 500 forward earnings for 5 minutes is where we got to before we bounced. And then the NASDAQ 100 more dramatically down to 21. That's exactly where it bottomed in April of last year. If we're still in the same regime and these earnings estimates that are going up can be trusted, then we've de-risked on the fundamental side. Now, that is regardless of what happens here, how long the oil shock happens and all the rest of it. So I think that's where the debate is. It's about, are we still in the same cycle? Are we still in the same mode? If so, then I do think that we've priced in, I would say, not the most adverse scenario, but one that is going to get back to normal without too much delay.
Yeah, because as we said on the program earlier, I mean, you could make a very, very compelling case on either side of the risk line.
You can. And the way I come down to is, if that was the low last week, like 6,300 plus in the S&P, it probably means the upside isn't super explosive because you never really got that far down and that washed out. So that's why the analogy with April of last year doesn't quite fit. But it's still worth keeping an eye on and being open to that possibility.
I'll see you later on the bell. Okay. Thanks as always. That's Mike Santoli. We'll do finals next. I'll see you at 3 o'clock today on Closing Bell. Brian Belsky, Stephanie Gill, Chris Harvey, Chris Ferrone, Robert Kaplan. So we got a great lineup. We'll see what this market does. We're also going to hear from the president momentarily, too. So we'll see how that factors into the trade over the final stretch. Let's do some final trades. Bryn, you're up first.
Google. I like the stock under 300. Great fundamentals. Technicals look good as well.
All right. Well, it's just under 300, 299 and change. All right. Steve Weiss.
Dick's Sporting Goods. Obviously, the bet I'm making is that Trump does not go after the energy infrastructure and impede the flow of oil.
Because you want oil prices to come down.
Exactly.
People to go to Dick's Sporting Goods and spend some money.
Exactly.
All right. Summarize that just perfectly, right? Farmer Jim.
JP Morgan Chase, all those IPOs are going to lead to banking fees.
We own eBay and Joe T. Stock's going to make a new all-time high above 102.
All right, so market's hanging in. We'll see what the president has to say, and I'll see you on the Closing Bell. The exchanges now.
You've been listening to CNBC's Halftime Report, the podcast. You can always catch us live weekdays at 12 Eastern, only on CNBC.
All opinions expressed by the Halftime Report participants are solely their opinions and do not reflect the opinions of CNBC or its parent company or affiliates, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this podcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Such opinions are based upon information the Halftime Report participants consider reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Halftime Report disclaimer, please visit cnbc.com/halftime report disclaimer.
Retirement isn't just about closing out your career. It's living the life you've always dreamed of. With New York Life, you get the financial guidance to make it real. Start today at nyl.com.